Hello, everyone. Let's begin. Welcome to yet another webinar of Thursday Talks. I am Ajab Ali, the marketing manager at Brooks Group. Before we begin, let me introduce Brooks to you. It is a leading firm in the UAE with offices in Dubai and a Brooks Management Consultancy, offering accounting, bookkeeping, taxation, tax residency services, tax agency services, ESR, business valuation, and UBU compliance, etc. Secondly, we have Brooks Biz Solutions, specializing in company formation, license renewals, PRO services, golden visa services, corporate banking assistance, and real estate management. Last but not the least, we have Brooks Creations, focusing on social media management, web designing, branding, photography, events, SEO, content creation, and so on. Our sister concern company is named Spicer Pegler, under which we offer AML compliance, auditing, and other financial services. So, as we all know, the UAE has introduced numerous new rules and regulations following the implementation of corporate tax. Article 4 of Ministerial Decision number 114 of 2023, that was on accounting standards and methods for the purposes of corporate tax law, has made it mandatory for a taxable person to apply the International Financial Reporting Standards, that is IFRS in short. In response to this mandate, and due to a high public response, we at Brooks Group are excited to launch a new series on IFRS in corporate tax. Throughout this series, we will delve into various topics related to IFRS and its implications on corporate tax through different episodes. So today's topic is the importance of IFRS in accounting, which will be expertly navigated by our Managing Director, Mr. Saleem Shahid. Now, it is my pleasure to introduce Mr. Saleem Shahid, our co-founder and managing director at Brooks Group, with 18 years of experience in accounting and financial management. Saleem leads our accounting and bookkeeping teams, delivering exceptional services and IFRS guidance. His expertise in process management helps clients enhance operational efficiencies and optimize their financial processes. So let's get started on this interesting topic, and we shall get to your question answers after Mr. Saleem Shahid is done. Over to you, Mr. Saleem.
Hello everyone, welcome to our new webinar of Brooks Management Consultancies. As she explained, my name is Saleem Shahid. So today I'm going to have a look on what corporate tax is saying for accounting and bookkeeping, how we can manage, what changes we need to have in our chart of account, in the books of accounts. So today I will focus only to summarize different clauses of corporate tax which are talking about the accounting and bookkeeping matters. So we will explain each methods and each clause and each type of accounting and bookkeeping in our later webinars, in our next episodes. But today I will focus on what corporate tax is giving the options to us, either a realization method, unrealization method, what available in the corporate tax, what reliefs we can avail, what we cannot avail. So my focus will be on what corporate tax actually talking about, accounting, bookkeeping, and the basis on what we will do. So let's start. So I will start. I know everybody is very excited to have questions on corporate tax and accounting, but let's have a few look on what corporate tax is saying. Then we will have a question and answers. So I will start from the compliance. Compliance related to books of accounts, documentation before taxes and after taxes. As we know, we are in this market since long. And we know that before the introduction of taxes, many of the companies, they are not even bothering to have a proper books of accounts. They are not even bothering to keep documentation. to keep documentations of the transactions. Then in 2018, VAT has been introduced in UAE. So after the introduction of VAT, so those businesses have started partial compliances. You can say they just started to keep the record of VATable transactions, either output of VAT, input VATs, but still they were lacking to have a full set of accounts and non-VATable transactions to follow the applicable standards in the country. So now, after the introduction of corporate tax, now every company have to be more compliant, to have a full set of accounts, to keep documentations ready. Every transaction should have supporting documents. Otherwise, those expenses which are not supported by documents, maybe the authorities will not allow to accept those expenses. These documentation we have to keep at least for 7 years. This is by law. By law, you have to keep this documentation for 7 years. Those businesses which are having a service, they are service-related businesses, they should have intact agreements, contracts with the customers, the suppliers, so that in future, at the time of filing, they will have a supporting to all these expenses, transactions. More than 100 countries in the world are officially adopted IFRS for their financial reporting standards. So UAE also announced that in UAE officially IFRS based accounting will be acceptable. So in other terms, UAE will be also aligned itself with the international market. So every business in UAE who is going to file the corporate tax returns, they should have to have their set of books of accounts with the IFRS. There are few reliefs available. No doubt there are some reliefs available. I will talk to two reliefs here. One is for those companies which are having turnover up to 50 million. So corporate tax is saying that, okay, the companies which are having turnover up to AD 50 million, so they can adopt IFRS for SMEs. They don't need to go for full-fledged of IFRSs. So right now, I'm not going to explain what is the difference between IFRS and IFRS for SMEs because it is very vast topic. So I can say only that IFRS for SMEs is just a shorter version. It's a very easy to adopt. It's a very less detailed, and the other relief which is available not to adopt IFRS is small business relief. So those companies which have a turnover up to 3 million, they can opt for small business relief. So this business relief they can adopt at the time of first return filing, corporate tax return filing. They can opt for this relief. And under this relief, they have some advantages, they have some disadvantages. So as I said, the first advantage is this: they don't need to follow IFRS based accounting. So they can have their own set of accounts method, like they can follow cash based accounting also, and they can file tax returns accordingly. One more advantage of having a small business relief is they don't need to pay tax on their incomes. Even their income is 1 million, 2 million, so they will not pay tax. These are after adopting this small business relief, they are exempt from taxes. But keep in mind, this small business relief is only for 3 years. It is clearly mentioned in the corporate tax law. This small business relief is only for 3 years. After 3 years, every company have to have their financial statements in accordance with the IFRS. So we are giving suggestions when many clients coming to us, even small businesses. So we are advising them to just start to have a accounting software, to start the accounting, to start adopting slowly IFRSs, so that after 3 years, suddenly they have to shift to IFRS, they will not feel any problems. So under corporate tax, so when we are talking about what corporate tax is talking about, the accounting, which methods, so corporate tax is also giving one option to the companies, those companies having assets, liabilities subject to impairment and fair value. For those companies, corporate tax is giving option. They can go for a realization method of accounting, or they can go for unrealization basis of accounting. So let me explain in small example so that we are on the same page. So, for example, one company having a property on their books of worth of 10 million. In particular period of 1 year, the property value increased to 12 million. So it means they have a profit of 2 million. So if that property has not been sold, it's still with the books. So that 2 million profit is unrealized profit on the books. They have to book the profit, but it is unrealized. If that property is sold out and they realize to 12 million into their bank or another consideration, it means they realized that 2 million profit. So this is the basic difference of realization method and unrealization method. What is realization and what is unrealization? So now those companies who are going to opt unrealization method, it means they are aligned with IFRS, because IFRS also going for unrealization method. So when you have a profit, the book value is increased, you can book the profit and you have to account for that profit in the books and you have to pay taxes. But some businesses, they don't want to pay the tax until they realize that profit. So for those companies who wants to go to realization method, corporate tax is giving them two options. So option one, if any company having assets and liabilities even on capital account or revenue account, they can go for a realization method. So once they realize the profit, only then they will pay the tax on that profit, gain or loss. So under option two, if any business having assets and liabilities held under capital account, they can go for a realization method, but the assets and liabilities they held on revenue account, they can go for an unrealization method under option 2. So under option 2, they have a both realization and unrealization method. So just to simplify which are capital accounts, which are revenue accounts, I will give you one simple example. Let's suppose one company have one property on their balance sheet, and that property is actually on capital account. But if that company's business is selling and buying and selling properties, they are falling under investment properties. So it means that properties are their inventory. So that properties are on their revenue account. So this is the small difference, revenue account and capital account. So when we are talking about how to align ourselves to more compliant with corporate tax and more efficient at the time of return filing, so we have to make some changes, which we are suggesting to our clients that, so let's have a small changes in our chart of account. We have to create new accounts in our chart of account. For example, deferred tax asset and liabilities. These are the ledgers which never before in our chart of account in UAE. Now we have to create these ledgers in our chart of account. And on the same time, deferred tax expense. We never had this expense before. Now we have to create this deferred tax expense ledger also on our chart of account. And we have to create some more specific ledgers and sub ledgers on our chart of account. For example, entertainment expense. We already have this ledger on our chart of account, but now corporate tax is saying if you are making entertainment expense for your suppliers, for your customers, for your shareholders, 50% will be deductible and 50% is non-deductible. So in that case, we are advising that let's have a two entertainment expenses. One is sub ledger, so that we can 50% we can book as usual, but 50% we book in the sub ledger, and same goes to fines and penalties, and same goes to non-business expenses. So that at the time of return filing, we can easily identify that these are the expenses which is non-deductible. We cannot claim these expenses, so that we can easily identify those expenses, or we can deduct from our profit and loss account. So in this scenario, we don't go through all the ledgers. We don't waste our time, and it could be prone to mistakes. So if you make your chart of account, some realign your chart of account in those manners, it will be more efficient also for you. Under realization and unrealization method, I skipped one point. Let me explain you again, guys. The selection of these realization and unrealization method is at the time of return filing. So every accountants and finance professionals, they should keep in mind, they should have a calculations. So whether we are going with the realization method, it is beneficial for the company, or we are going to a unrealization method, which one is beneficial for the company. Because once you opt for one method, you cannot change it again and again. So it is very important. So have a discussion, consult with your consultant, and have a detailed calculations before opting for this method. So thank you to having with me. So I'm handing over to Ajab for the question and answers. Over to Ajab.
Let's start taking the questions that have come in. And dear participants, please keep your questions coming in. So the first question here, Saleem, is IFRS compulsory for corporate tax in UAE? Or can I use other accounting standards as my company is based in the US? I would prefer to follow GAAP for alignment with my head office.
If your company is having a tax return, filing the tax return in UAE, they are a permanent establishment, maybe they are branch here, or maybe their legal entity in UAE. So in UAE, because you are filing tax return in UAE, you only acceptable is IFRS. You have to have your books of accounts in accordance with the IFRS. Then maybe you have to have separate set of account in accordance with GAAP to give them. But in UAE, authorities will accept only IFRS based accounting.
The next question would be, how should companies account for non-deductible expenses or non-taxable incomes?
As I explained, management reporting having some different scenarios. Management want all the expenses. They want to see actual position of the company. So maybe from management point of view, you have to book these expenses. But law is saying some expenses are not deductible. So better to have make some changes in your chart of account, to make some ledgers, sub ledgers under the ledgers. Whatever expenses are deductible, normal corporate tax is allowing you to, these are deductibles, you put as normal. But if there are some expenses, as I explained, 50% of entertainment expenses and non-business related expenses, so fines and penalties, so you should create new ledgers and you book these expenses. When you will create a report from your system for management purpose, you can see the position. When you are going to file the VAT return, so you have options. You know what are these 3-4 ledgers are non-deductible. So it's very easy. Just remove that ledgers from your calculation, and you can file it tax return. So it is more efficient way.
The next question would be, how should temporary differences be identified and accounted for, especially in relation to asset reevaluations, provisions, and accruals?
Thank you for this question. Actually, this is very vast and detailed topic. So, as any business opt for a realization method, so it means you are going to have a profit, you are going to calculate the profit to file the return only once you realize that profit. But in IFRS, you are booking the profits and losses when even it's not on unrealization method. So in that scenario, there could be a chance that you will have a deferred tax asset and liability. So you have to create ledgers and assets and liabilities in your balance sheet so that you can book the temporary differences over there.
Thank you, Saleem. So, when does 3 years of exemption expire for SMEs?
Yeah. So for small business relief, this SME, there's no time limit is mentioned. So I believe this will go far with the long term with us, because for SMEs, IFRS for SMEs, there's no limit mentioned, no time deadline is mentioned. Only small business relief, it's mentioned that 31st December 2026 is the last time. After that, this relief will not be available for the companies.
All right, thank you. How should companies account for the tax effects of leases under IFRS 16 and IAS 12, particularly in relation to the recognition of the right of right use of assets and lease liabilities? Mr. Mazahir, would you please take this question?
I would like to take this question. So the question states, how should companies account for tax effects of lease under IFRS 16 and IAS 12, particularly in relation to the recognition of right of use assets and lease liabilities? As we have mentioned, and it's been mentioned by Mr. Saleem Shahid, that IFRS is the key for the corporate tax calculation. So definitely, when we talk about IFRS to be fully applied, we have to take into account the complete IFRS 16 and all the applications of IFRS into your book of accounts. So it doesn't mean that you can only choose one or two IFRS and leave other IFRS. When there is an application to be applied, it has to be applied in whole. So definitely, if a provision is applicable to apply IFRS 16 and IAS 12 within your books of accounts, that will be accounted as part of your balance sheet as well as P&L if there is any impact, and it will be taken for the calculation purpose of your taxes for profits. Your calculation for your profits and for the tax purposes. I hope I'm clear on this question.
Thank you, Zafa, for taking this question. Do we have any more questions coming in? Alternatively, if you have questions coming in later, please feel free to contact us on info@brooksme.com. You can simply call on 055-378-1492. Ms. Jane Timbang will be more than happy to assist you. Don't worry, this series is going to go on for a while. Stay tuned till our next episode, and we aim to explain IFRS in more detail. In the next session, we will discuss the difference between accrual and cash-based accounting in IFRS. Or if you have any topics you'd like us to cover or have any questions related to taxation, please feel free to contact us. The contact details are mentioned. Info@brooksme.com, 055-378-1492. Thank you, Mr. Saleem Shahid, for this amazing session today. And dear participants, if you have any other questions, please do email or contact us on the given contact details. See you next week on Thursday Talks. Thank you all for joining in today.
Thank you all.